All right, rock and roll. We got our next panel here, our next discussion, and we're going to be yapping about real world assets. And I'll let the panelists start by introducing themselves. I'm JP Vega. Still not working. Here, why don't you can use this to start.
Testing.
Hi, I'm JP Vega, CEO of Souq. We're building a new capital market on chain.
Hi, I'm Sid Powell. I'm the CEO of Maple Finance. So you can think of us as a DeFi lending platform, more focused on institutions. And we've done about $2 billion in loan origination since we launched in May of 2021. And very excited for the trend in real world assets this year.
So let me start off by asking, who did Maple ask for permission?
Permission to lend?
Do whatever you're doing.
No one. So...
And I just want to contrast that. And are you asking anybody?
We're working with a Latin American regulator to receive permission.
And how long have you been in that process?
About 120 days we've been in the process. We recently submitted 2 license applications. It's a process that'll probably take about another year.
Do you have any sense of how much that's going to cost?
No, it's a very complicated process.
It's a fair question, though.
Yeah, no.
Because I mean, have you ever thought? So for me, my experience when I first got into crypto, I raised $2.3 million in January of 2018 because I wanted to raise a $100 million security token VC fund. But there were some legal and technical issues that needed to be solved. And while we spent the $2 million, we actually did not solve the problems. And I thought, it was going to be a very, 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 very long time to solve the problems. And, I think up to date, we've seen obviously more growth on the people who didn't ask permission side.
Yeah, but just to clarify that. So in terms of the lending you're doing, is this consumer lending?
We're not doing any lending. We're more focused on bringing right now specific debt instruments. So you can think public debt, government debt, those types, mainly like AAA rated.
Right. Commercial lending is not regulated in most markets, so that's why you don't need permission to operate a commercial lending business in most markets.
And and I say this here, I'm a very big believer. I wrote a post called "Prepare Yourself for the Security Token Tsunami." And I've written more than 350 posts, the second most read one ever, and that was, I think, like February of 2018. So it's just a little early. What do you think needs to happen now for it to go from, because obviously it's a better system, right? I mean, there's nobody argues that it's not going to be a better system, but everybody struggles with how do we get from here to there?
So I think our perspective at Souq is we think about where is wealth accumulation right now, and it's, the top 10%, 15% have the majority. It's a power law. And so we're really focused
It's in the Middle East.
We're really focused on the long tail of people that have been traditionally locked out of these markets. And we're using crypto as a way to coordinate that capital outside of the traditional financial system while still giving them the same protections and access to what are typically reserved for institutions or accredited investors. And I think
that's God's work. Who are you getting inspiration from? Who's done that?
So for us, it really comes down to the fact that the way that capital is allocated right now, it's a small segment of humans with a very specific bias. And our belief is if we can shift that to be a more normal distribution, we can improve the efficiency of how capital is allocated, what we're spending money on. And there's a lot of infrastructural problems that we're facing, especially as we want to transition to new energy. And I think those represent great investment opportunities, but I also think those are things that the average person would want to contribute to. And in that, we think there's an opportunity to create incentives, but also align those with actual outcomes that shift humanity forward. And that's kind of the opportunity I see with crypto, is that ability to coordinate based against things and know where your money is going in a way that you can get behind and you can align your passions to what you care about. And you see that a lot in DeFi and a lot of the culture, but we want to really tap into that in a base of users that haven't been able to create or generate wealth.
And I think that makes a lot of sense. But I think you have to worry about where your money's going. You have to worry about, is your money really your money? A lot of people who had money at Silicon Valley Bank, had a long weekend when they thought maybe their money wasn't their money.
Yeah.
So why don't you talk about the growth of Maple? Because you guys have had some really nice growth, and kind of what's worked for you and what you're leaning into.
I think most of our early growth in loans on the platform came from lending to market makers. So these were the biggest businesses that had an appetite to borrow and were willing and able to pay interest on the loans. So
Where were they geographically? Where were they?
mostly different financial centers. So you'd see a lot out of Hong Kong, Singapore, some that would be operating outside of the Cayman or BVI, but who are domiciled in Cayman and BVI. You've actually seen a lot of trading firms shift and now relocate themselves into BVI and Bahamas, but as well UK as well. But any major
I didn't
financial
hear you
center.
mention U.S.
No, well, you see some of them operate out of Wall Street, but most of them, and actually a lot of them are borrowers, whether it's like Tower or Hudson River, DV Trading, but there's a number who will borrow from Wall Street. But we actually saw that the largest appetite for market makers was probably like Singapore, Hong Kong, and London. And so that was what we capitalized on. So lending to that market allowed us to reach $2 billion in loan originations. The market went risk off really from May of 2022. So you see pricing increases. The retail trading volume dropped off, which meant that there wasn't as much lending appetite. So now you've seen the lending space has evolved to now encompass real-world assets, as you mentioned before, and so you're looking for more places to park capital as well. I would say what we're focused on at the moment is low-risk options. People want T-bills on-chain, low-risk government securities, and the other one is revisiting that market maker space.
But when you say people want that,
yeah.
So if you were to provide it to them, how do you do that? What's the channel?
Yeah. So we just launched last week a cash management pool. It'll launch properly next week. We did the marketing launch last week, but how it's structured is they put money into a pool. They go through a whitelisting and KYC process to do that, and then the pool will do a loan to an SPV. So the SPV can only borrow from us, and it can only buy T-bills through a regulated broker. What it does is it gives a way to bring a proxy for the risk-free rate on chain, because now what their borrowing costs now becomes something akin to a risk-free rate on chain.
Is that available to only institutions, or is that broadly available to other market participants?
Accredited investors.
Okay.
So just with the way that the kind of the regulatory landscape works, it's like you can do an exempt fund if you only take money from accredited investors. It'd be great to offer that to broader retail, but it becomes significantly more costly and a much lengthier registration process, as you found.
Yeah. So I'm sorry. So obviously I'm pretty deep in this area, but as deep as I am, I'm not nearly as deep as one of the partners who's actually here. So in terms of like asking questions, I'd actually be super interested in hearing the questions that he would ask. So Andy, you want to come up and ask? I'm sure you're listening to this. Have some thoughts. Have something to add, or no? You don't want to come up and ask a question.
Sure. I'm interested in the treasury. So who are you targeting with that is not buying through their normal, kind of SMA accounts and stuff?
Two segments.
Real quick, So in July, we started a company called the Crypto Oracle Collective. We're a decentralized Web3 advisory firm. We started with 24 Web3 experts. We're now 200. And Andy is our DeFi expert, and I've known Andy for a while, and he's the smartest guy I know in DeFi.
Yeah, sure. So, two key segments. So one is offshore, and then the other is crypto, and so you can have the two have a heavy overlap as well. So if you're a crypto startup, a lot of banks find it very hard to bank you, and brokers also won't touch you. If you're offshore as well, you don't have as good access to these kind of T-bill-like products in your home jurisdiction. So it appeals to both of those. The other segment is people who have capital stuck on chain, or they have a mandate where they have to keep it on chain. So think DAOs. They can't go and set up a bank account and trust somebody to keep the bank account in their own name. And high net worth individuals who have crypto wealth that they prefer to keep in USDC, USDT, and not off-ramp it back through the banking system.
So a big issue for these kind of DeFi pools is that people are not willing to go with a long duration. You guys got stuck with that problem. What's the withdrawal kind of window? What's their call?
Daily. So 24 hour. So the way that the mechanics of the protocol work now, you go through withdrawal epochs. So before you had this issue where you go and you deposit, you have this countdown timer to where you get from 90 days to 10, and then you can withdraw anytime at 10 days notice. So it creates an incentive to kind of try and front run each other. What you have now is you have epochs. So you can set that to whatever you want, and then somebody needs to go through a full epoch, but they get treated the same at the withdrawal window at the end of the epoch. So in this instance, think of it like every 24 hours, a 2-hour window opens in which you can withdraw, and you're treated the same as everyone else who wants to withdraw in that window, and they get pro rata access to any cash that's available.
So do you intend to keep cash, or can you settle a trade in 24 hours? What's the tactic?
Yeah, no, you should be able to settle a trade in 24 hours. So you send it through, Fireblocks wallet, Coinbase Prime, to the broker, and then if you need to liquidate, then they sell the treasuries, or they're doing repo, so they can pull it out of the repo facility, bring it back. So the biggest issue is the window of time between getting from a broker via a bank wire. So the biggest vulnerability in the system is the bank wire, which can take up to 5 hours sometimes. So that's the main thing to solve for.
Okay, so you mentioned that you're focused on Latin America. Can you talk about what's going on there? And, obviously, we all know that right, horrible inflation, right? So you think, okay, this is like the perfect thing for them. Yet, adoption is like, I was actually recently in Saigon. That's the most adoption.
Yeah, so I think there's a couple trends that we're riding on the retail environment. One, high interest rates. So they're just outcompeting DeFi. You can get AAA rated 8 to 12% right now is what it's being issued at. The second piece is they have a low.
Wait, who's issuing that?
Is that AAA?
AAA, yeah. Those are, yeah. You can read financial statements of companies that are looking to raise debt, and there's quotes on what the new debt is going to be raised at, like the forecasting of the interest rates. And that environment, we don't know how long it's going to last. But what is unique, these countries don't necessarily trust their government or their politicians or their currency. And a big point of adoption in crypto is remittance already. That's like a pretty common way that they store money or are getting paid. And what we want to do is provide them vehicles where they can now park that money in something that is highly rated and a top-tier investment product that in their normal financial structure they wouldn't have access to. And that's what we think, if we can make that available, that's a really compelling way to bring more money in the system on top of what's already being done through remittance.
How do they on-ramp?
So they cannot, our goal will be following the local regulations, but one of the licenses we'll be receiving gives us the ability to pool retail capital. And the way that we're pooling that retail capital, we basically look like an SPV or an investment collective. So the institution itself will be KYC'd, AML, but the funds that we transfer or the representation, the derivatives that we put on chain don't require us to go through the KYC process for the retail user. But there are jurisdictions that we will not touch because of some of the regulatory enforcement actions that they've been taking. So we'll be focused on where that's not prohibited and where that's allowed based on the licensing that we have.
Where is that?
It's one of the largest governments. It's a $1 trillion economy, but we're not going to be talking specifics until we finish some of the licensing process.
Well, the reason that one thing that
Andy, you got a mic.
Yeah, so one of the main things that I've heard about fintech in Latin America is that the margins are fat because it's an oligopoly, but that obviously that oligopoly structure varies from country to country. Is that your experience? Is
Yes.
that why the opportunity exists?
Yes, there's a lot of centralization in the players, especially in Latin America, basically mainly out of Brazil. If you exclude Brazil, a lot of the financial system is in the same way that Canada sometimes mirrors the U.S. A lot of it follows, for example, Mexico, and it gets adopted. Mexico you can kind of think as like the financial capital of Latin America, the New York City of Latin America. And a lot of the regulation gets passed through and passed down and adopted by some of these other countries. And that is one of the opportunities.
On the sourcing capital side, did you mention, is it mainly going to be like a retail targeted product?
Retail, we'll be pooling the capital on chain.
Okay.
So you come in, you deposit a stable coin or a stable asset into a vault, which is essentially an ETF. It could be a single source of debt. It could be a mixture of debt, in the same way that you have those products available through a brokerage or anything like that.
Yeah, it's very interesting.
And what's the currency?
The currency on the fiat side, or so we one of the licenses is a money license, which allows us to hop between digital and any currency. It could be USD, it could be pesos, it could be like Mexican pesos, Argentinian pesos on the off ramp. But what we're creating on the DeFi side is the ability to rotate these positions in a decentralized exchange. That's one of the things that we want to encourage is only using the off ramps when necessary and seeking liquidity in another manner. In the same way you.
So if you're
rotate
holding the
coins.
assets in DeFi, is their value quoted in, say, USD, the real bank USD, or is
Yes.
it quoted in a stable coin?
It would be quoted in the current market value. Like, so if it was priced, for example, debt priced in dollars, that's how it would be quoted.
And happy. So, I was like, if there are any questions from the audience, anybody out there listening to this good stuff, if there are any thoughts, raise your hand and we'll let you guys ask some questions.
The US dollar. USDC. USDC.
I was just saying that a lot of these DeFi pools denominate in USDC, which we now know is not the same as USD, and certainly has some conversion issues.
Yeah, I think a lot of the
Is
challenge.
that different to any bank deposit, though, if you really think about it?
Well, if you're holding your assets off chain, then they are USD assets. If USDC goes away or depegs, they still have a USD price. So you get a weird
but
arbitrage.
The depeg risk of USDC is the insolvency of some of the banking partners. Like, I mean, in the USDC's case, the the primary issue was that they had 3.3 billion at a bank, and that some of that was potentially going to be unrecoverable. So it's the same counterparty risk for any sort of banking deposit.
Yeah, I'm just saying you don't have to. In theory, you don't have to absorb that risk if your assets are off chain. It's just a technical point, which occasionally becomes interesting.
Mm-hmm.
Yeah, and if you want to price things in USD and some of these like non-native stable coins, there has to be some sort of Oracle system. I think that's one of the challenges and why it's not prevalent. But there's existing these like creating derivatives. The structure already exists in financial markets. These things are done all the time OTC. So I think there's an opportunity to leverage the existing financial structure on the TradFi side and connecting that to the availability of a variety of different tokens, whether they're stable euros, stable coins, USD, Ethereum, as a mechanism for just changing out liquidity.
Yeah. And this day is coming. The only question is when.
Yeah, agree.
But would you say that? How would you classify that business the way you've envisioned it? Is it a bank? Is it an exchange? Because you're really using it that way, right? It's a way to get into crypto and yielding assets. Or is it a protocol and you've outsourced the kind of the wallets and the on-ramp?
So the way that and this is a continually evolving thing, but the way that we're going to be positioning this is a crypto exchange, not a traditional exchange. And there will be opportunities to off-ramp.
It's a crypto exchange with an asterisk.
Asterisk in the sense that it's decentralized. So it's not there's no central order book. We use an AMM that we have written the code for, but you can participate it in the same way that you can swap coins in Uniswap. The only difference is we have NFTs, and there's a unique property in which we need metadata associated with the token, and so we have a AMM that's focused on trading these NFTs and does really good with net asset value and a NAV component. Really efficient. And so that's what the exchange will be registered as, and that will hold the license. But anyone can participate as a market maker. Anyone can swap in and out of these assets. And we really want to encourage these things being composed inside of DeFi. We think that's the unique thing that is
Okay,
really
we got time for one quick question here.
Yeah, one question. I sat on a Zoom call with Jeremy Allaire a couple days ago, and he was talking about, to your point about reducing or mitigating counterparty risk. They were using short-term T-bills. Do you think that are there going to be pathways of remediating that type of counterparty risk, or even to Souq's business model as well?
I think there's existing vehicles like money market funds or things like that, products that depending on what you're trying to do, might be advantageous. Sometimes it lowers the yield. Sometimes it adds more complexity. So I think the duration challenge exists in TradFi, and there's multiple ways around it.
Yes. Have you heard of SVB?
Exactly.
Well, I mean, but that's an interesting difference between like Circle and Paxos. So Circle buys an ETF from BlackRock. There's a lot of layers in managing that fund. Paxos runs their own trading desk. They buy repos, which are overnight, no duration, commercial paper, right? They can go kind of bare metal to buy these assets. Might be a better model.
ETFs, you sometimes have some tracking risk. I mean, it's typically pretty small. But the other model to what Mark was saying is you can buy the assets directly or engage in some kind of repo through like a tripartite agreement.
Okay,
So,
I'm sorry. I'm going to get the last question real quick. Should the government, all three of you, should the government have saved SVB and Signature, or should it have let them failed?
You know, I think that at the end of the day, it's people's hard-earned money and equity at risk, and so I do think that when the financial controls fail, there should be intervention, but there should be a redesign of the system that led to that type of exposure.
It's a good question. I come down on finding it hard to give a one-way answer to it. I think Signature probably shouldn't have been shut down.
Do we have an answer?
But I think overall it was probably the right thing to do. The problem is they continue to feed into a system that's now getting less stable over the longer term, right? If all deposits go to JP Morgan, no one can bail out JP Morgan, right?
Nobody could bail out AIG, right? It's the same thing.
Yeah. But a system where you end up with a market structure that is heavily concentrated in a few players becomes unstable over the longer term, even if it's less volatile over the short term. And now JP Morgan could never be bailed out. Like if something wrong happened there.
Well, to me, we're on a slippery slope, and there's no way to get off of it, which is people want to go to the biggest bank. It's going to have the most systemic protection. And they can now because everything's online. All the banks are equally accessible. And they're going to want to go to the biggest stable coin. Maybe those guys offer a deposit coin, but it ends up concentrating so much money in one place. It's called concentration risk. They're going to have to regulate it as a CBDC.
And we're over time now, but I saw a statistic, and maybe it wasn't true because who the fuck knows, but it's that the big banks lost a higher percentage of their deposits than the small ones.
Certainly the small guys have held up better than expected, which maybe was an argument I would have said, yes, the government should have bailed the banks out.
Because the most sophisticated people with the most money took their money out of the system and gave it to the government, to buy the T-bills to not have any risk.
Yeah, as long as the government is bidding against its own banks, that's tough.
Yeah. Which is a problem, right? Because if all of the capital in the country goes into T-bills, that's government borrowing, and it prevents credit creation in economies, right? Like you can't have the local business can't borrow if all of that money has already gone into T-bills.
That's a big problem with the whole stablecoin system. They want to put that money. If you buy stablecoins, they want to put into these very low risk reserves like T-bills and even Fed reserve accounts. Comes out of the economy. It's going to be a huge problem if everybody goes to buy stablecoins.
The bottom line is.
Except, sorry, I was just
got to send your money to Sid or JP Morgan.
Well, I was going to say the stablecoin is a derivative on the T-bill, and the stablecoin can actually be lent out to create credit. So, provided that they could borrow in stablecoins and not have to go back to fiat, then
that's what Alex Machinsky was doing,
and it can be active.
No, anyways, the bottom line is they should have given this panel an hour, but they did not. So let's give them a hand.